Yes, yes, I'm here.
Okay, I wanted to record this so we can have a record of this. Okay, we're back to the screen. Okay. You can say I'll start you from here, but basically I want to say this first. The most important thing in trading is this is one of the most important things, the time frame itself. You need to start from the biggest time frame, analyze the bigger time frame, then start drawing down to lower time frames. Because the time frame allows you to see the big picture in the bigger time frame. Then as you reduce your time frame, you start to see better. Hence, it's important to now start taking entries from 1 hour, 30 minutes, and 15 minutes. You can take your trades. The bigger time frame is for analysis only. Unless you have got a big money or big capital, then you can trade in big time frame. Like for instance, if I've got so much money, I'll see this at this point, I'll just buy because the retracements there, they won't affect me. Okay?
Yeah, I believe that's one of my biggest issues as well is the fake outs.
No, I'm here now to help you because I'm trading smart money concept, and smart money concept, we focus on those fake outs to finish first. Then we start trading. Because the fake out is actually the manipulation by the institutions to take out our stop losses. So once the manipulation has happened, then I jump into the market. What I mean is this: when market is moving like this, it creates the higher highs and lower lows. So as it was going that way, it left the lower low, at this point, then carried on. Another lower low at this point, then carried on. So what I do is you have to mark these points. This one I marked, then you mark this lower point as well. You see? On its way, on prices market, when price was rising from this point to this point, it left how many lows? This low and that low. Are you with me?
Yes, I'm with you.
Yes, I love the responses because they just give me that boost. So as price was going up, it was leaving lows. First low, second low. Okay, and then carried on. But just before I continue with this, I want to say that the most important thing in trading is looking at your time frame, the higher time frame, then draw your trend lines to understand the overall direction. Okay, when you draw your trend lines, then you have to draw your support and resistance. That's where
I believe that's one of the things I was left out.
Yeah.
The trend line. I normally just use the support and resistance or supply and demand.
Yes. So what's happening is as prices going up, it's leaving the lows. You mark the lows. They become the support. As prices going up, you mark the high. It's your resistance. As price comes down, you mark your low. So I've got 3 lows, important points. 1, 2, 3. So let me delete this ABC thing. It's confusing us. So I've got 1, 2, 3 areas. Even when price was going up, the high, I marked it. Can you see? We mark the high, we mark the low. 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 That's it. That's it. Why doing that? Because below the previous lows is where you find liquidity. Liquidity is found here. The liquidity is what we are after. The liquidity is what we are after. Okay? So the whole purpose of trading is just about finding liquidity. Finding the money, where the money is. Because when you know where the money is, you will know. When you know where the money is, you will know that you will know where the banks will have interest, and you will know when the banks will take liquidity, that money, and then you jump in at the right time. So in this case, there is liquidity accumulated there. Okay? There is liquidity accumulated there. At some point, I was expecting for the institutions to spike just above this previous low to take this liquidity. Okay, they didn't take this liquidity. So it means there is still money here, and price dropped and again came back, but we are this low. This is also liquidity. Are you with me? This is also
Yes.
liquidity. So the banks did all this effort to take this liquidity. So this place qualifies to be what you call an inducement. The lows below the lows above the previous low, the lows above the other lows, meaning this becomes the inducement level, and as liquidity, which liquidity will be taken with this action. So what do? I wait for this to happen. When I've got this low here and that low here, I know there will be a vacuum here, which the banks must take, correct this liquidity, wait for price to close above this low. Well, you see, as price was going back, price will come here. We wait for price to come back and retest the previous low. That's when you buy.
So there would be the entry.
The entry is here. This is the entry from here to here.
So normally, what normally messes me up, right? I would normally wait for it to break the zone, retest it, then go through the resistance that would actually be there.
Mm.
Do you understand what I just said?
No, I come again. I missed that, I think.
All right. So what normally messes me up, like I could see the entry, but I'm not what I'll say now, confident in it. What do I normally do? Like where it go through the zone, right? After I break the liquidity and retest it, I normally wait until it goes back up before entering.
Yes.
So I guess I'm always late on my entries.
You know my advice? My advice, now that you have come to me, try and that knowledge you have is good. You already have it now. To try and change the approach by using what I'm going to show you now as an added knowledge to see the value. So try and focus on exactly what I'm saying. Don't worry about your mistakes in the past. It's good for the knowledge and what the information and for who you are now. That was like lessons. But what I'm going to show you now, it's going to change the game because I'm going to add spice to what you already know and make it easy. But try and master what I'm saying. That we establish trend lines first. In a bigger time frame, we establish trend line first. So I advise that you have, if you are trading for 375, I advise you have 3 charts or 4 charts open. One for 24 hours, one for daily, or one for weekly, 2 for daily, for 4 hours and for 1 hour.
Bro, that's information. Let me write that down really quick, all right?
Okay. So what I'm saying is, you when you are trading, when you start trading, analyze your bigger time frame, analyze the week. So you'll have this analysis for weekly. Then open another one. So on 75, you have got 4 open charts, different time frames, daily or weekly, daily, 4 hours, 1 hour. So you understand the story it's been telling. So there's a storytelling in weekly. It's going to tell you a new story also in daily, 4 hours and 1 hour, but they'll all be pointing in the same direction.
Definitely.
Okay? Because the same analysis, the way I've done it, it's going to appear in, if I open, this is 4 hours. Let me open a daily. Let me see if I can open another daily so that we can analyze the daily. Let's say, which one can I take?
And they use Tradingview to save the charts, right?
Come again?
They use Tradingview to save your chart.
Yes, I'm using Tradingview implementation for binary.com.
For binary.
Binary.com. You save right at this point. You just click here and save. So what it is, so check
where
here.
you click to save?
Okay, I'll show you now. This is now for, look, you see, we were looking at, you see this part is what we were looking at. You see the transition. In 4 hours, this is what I've been looking at all along. Just this part in 4 hours. Weekly, I mean daily shows you everything. Now it's a bigger picture. So now I've got two charts. I've got 4 hours and 24 hours. So what happens is, look at this. I want to show you the uniqueness of seeing all time frames. Now check this. In a bigger time frame, look at the trend lines. I traded the trend line until it's finished. Can you see how unique was it? So this trend line, I was trending this trend line after, what I did was, okay, let's say this trend line to the downside. Look at this. And in daily, I established my support and resistances, the highs and the lows. Can you see that?
Yes, I'm definitely looking.
So I'm looking at, look at this. This was amazing. You see, we will make a lot of money. It's just a matter of patience. Look at this. Highs and lows. Now, the secret is there is highs and lows. Highs and lows. So this is what you do. You open any chart, open any chart, and open any chart and put trend lines and then support and resistances. Then we detail in the support and resistance. Previous high, there is liquidity above there. I will symbolize liquidity for you to see its money. I'll put the dollar sign. So there's liquidity there. There's also liquidity there. So the reason for me to do the support and resistance is above and below, there is money. Above and below, there is money. Above and below, there is money. The banks will take this money by increasing what the bank basically do is they will buy and sell. They are buying and selling at this point. Did you know that?
Yeah.
Banks will buy and sell. They always do this. They never lose. So what they're doing is they're buying and selling. When they see we are so many of us selling, they will put more buy orders to push price higher to our stop loss. Imagine our stop loss is here. When we buy from here as retail traders, we don't have too much money. So our stop loss will be here. When we are selling here, our stop loss will be here. So the banks, they will see, oh, this guy's stop losses are here. They can't. So now the bank use us to find the direction of the market by chasing our stop losses. So they know we are here and we are putting stop loss here. They'll add more buys. They'll put more money on the buy orders to push price higher, just to cut us out of the market. Then they will drop the price. Are you with me on this one? I want you to get this one.
Yes.
So the banks pushes price higher. This is called manipulation. And then once they know we are all out of the market, they put more money to sell now. They close they close the buy orders, they put more sell orders here to push price lower. Can you see that?
Yes, then it would retest that sell zone.
And comes and tests the same trend. This is called retesting of the previous high.
This would be where the Fibonacci would come in, right?
Come again?
This would be where the Fibonacci would come in, right?
Yes. Then Fibonacci comes in from there. That's a good point. I actually like that. You're making it easier for me. From that point, you do this. This is 50%. You must start taking your trade. You must start taking your trade. Okay, this is where, let me do this. This is where the previous high is. So you can take your trades, you can take your trade at 32, 38.2 or 50, but not at 61, because 61 is above the previous high. That becomes invalid. Invalid. When you take your trade from here, your stop loss will be above 61.8% because it's invalid. or above 78% because it's invalid, or above 100 because it's invalid. Get the concept?
Repeat that once more.
Okay. So when you can see this is the previous high. So price goes, takes this liquidity above this previous high. The type of liquidity is called buy stop liquidity. The banks buy stop liquidity is called BSL, buy stop liquidity. The type of liquidity that you find here. The banks will buy to stop the stop losses of retail traders. So the banks buys to take liquidity, pushes price lower. When it closes below the previous high, you measure the Fibonacci from the previous high to the new low to get the to get the what you call this, to get the pullback. But this pullback percentage you must consider up to 50, because 50 is the only one that is exactly at the previous low. Can you see this black line? This one.
Yes.
That black line there, that is 50. This line stands for 38.2. This one stands for 20. You can only trade percentages that are below the previous high or exact at previous high.
Oh, so you're saying that the previous high that is on the left-hand side, if the pullbacks are exactly there or below, we can enter the trade.
Yes, you can enter trade that tests this level.
But if it passed it, it's invalid.
Yes, if it's above this one. If price,
yes.
Can you see that this price, the price here, what can I use? Let me use it. Can you see that the price here at the far end here? At the far end here. You see that price is 154 something.
Yeah.
You can't buy any price that is now above that, like 108 and 84 something. You can't sell when price is above the previous low, high. You don't want to sell when price is above the previous high. That's a secret. Let's do this.
Because in that case, you can actually turn to a buy.
You know, you don't want to buy anything above this level, shaded area. You don't want to sell at 61.8% or 70. These are your stop losses. Percentages above this become your stop losses. Remember, you said you don't know where to put stop loss. Your stop loss is above this 61 and 78 and 100.
And that's in general with every trade or just on this trade?
Come again?
Is that in general on every trade or it's just on this setup?
Yes, any trade. Look at this.
So 50 would be the entry zone. Yes,
let's look at this. Consider this. You see, this is a high. I said when price makes the high, you draw a line. When price makes another high, you draw a line. When price makes a high, you draw another line. So these are called 3 equal highs. Okay, but now there is also highs that we can't ignore. These highs, we cannot ignore these young highs. Can you see these previous highs? They're called inducements. Above them is liquidity. So price was here and dropped, came back here and dropped, and then went to go above these previous levels, taking this liquidity. When price drops and closes below this previous line, we qualify to sell this. Am I making sense, bro?
Yeah.
Okay, so now check. Again, we have this high, we can't ignore. Can you see that if I continue with this high, can you see the importance of this?
It goes right across.
You see? So there's liquidity again here. The liquidity here was taken by this. The liquidity between here would be taken by this. Okay. Now what do we do? Once liquidity, remember when after taking liquidity, what do? We then employ Fibonacci. We employ Fibonacci from there to there. Can you see?
Yep.
And when do we enter this trade? This is what I'm
50%.
I'm teaching you very key entry points. So this is where you enter this trade. Why? Because it is below the previous high. So which percentage qualify here? 28.6, 23.6, 38.2, 50%, 61%, 78.6% qualify. Your stop loss, if you enter here, will be above 100% because 100 is above this previous high and it has become invalid. Okay?
Yeah, so basically what you're saying is that once it below the resistance, there would be the entry, and then the next level on the Fibonacci would be the stop loss.
The stop loss, yes. At this point is the entry. The stop loss is above the higher point, above the previous high. The stop loss is above this one that takes liquidity, the manipulation. Hello?
Yes, I'm listening.
Yes, stop loss is above the manipulation. This is called manipulation, fake out. Fake. Fake. Can you see that? So,
Yes, I'm seeing it.
now, can you explain to me, can you see that is the same similar thing that's happening even here? What do we have? I said when price is dropping from here to here, it leaves the highs and lows. We mark the highs. Can you see that?
Yeah.
And again, price continues, leaves the high. What do? We mark the highs. And we said, between these previous highs and new highs, we've got liquidity. That is what the banks are interested in. They see we are sellers, we are busy. We are busy. They can see us busy selling. They can see us selling. But the banks will use us to find their position in the market. Don't forget that the banks uses us to find their position in the market. So the banks are trying to find, to see us. So look, it's us. The banks are not involved yet. It's us. It's us. Once they see us, they will buy at the same level we are buying, we are selling. They will sell at the same level we are selling, but they will also buy at the same point. Did you get that?
Yeah.
They will first.
That's what create the fake out.
They use us to find position in the market. Once they see where we are, they will go and sell at the same level. But what they do is they don't only sell, they buy and sell. That's a strategy they use.
And that was sometimes create the double top as well, right?
Yeah, no, yes, you are right. But I want you to use the language I'm using.
Okay, no problem.
Yeah, there's so much information and there's so much common language that if you say that, you're gonna need to go deeper in that. So
Understand.
So instead of us saying double tops, we're gonna say supports or resistances, supply or demand, at least. Because I used to understand, I used to think about double tops, but I didn't really understand what it meant. Oh, I mean, I didn't understand how to execute market just by knowing that. But what I'm saying now is above the double tops, above the double tops that are the supports or resistances, I mean, that are the resistances, we have liquidity, which the bank sees. And that allows for the banks to take position in the market. They will first see us. You see, after we double top, or after we make these two highs, equal highs, double tops, I call them equal highs. After we make these equal highs, the banks now see that we are here. So they will buy at the same point, but they will buy and sell. So they will push price higher by increasing more buy orders to take us out of the market. Then they will close when we know they've taken us out of the market. Then they will close the buys, add more sell orders. That gives price momentum. So look at this, price pushes down. And what does it do? Sometimes, remember I was saying you can trade percentages below the previous high levels. But this time, all the time it was touching the previous high, which was touching below the previous high, remember? But
yes.
this time it chooses not to touch. And what percentage is that? We need to measure the percentage level exactly at 50%. You see the same level like that, see 50%, price chooses 50%. So at 50%, we can start our attempts to sell. Do it make sense?
Definitely. Definitely. So basically, you wait on the retracer, then to enter.
Come again?
You wait for the retracer on the
Yes, that's when you are trading like a pro. You wait for price to push. You know the banks what they're doing. You are aware. If you understand, can you see that this is a similar pattern from there to there?
Yeah.
Similar pattern even here. Equal highs. They take liquidity, they drop price, come to test. Can you agree with me? We are in the same sequence here. Look at that.
Yes, we are.
High, drop, then take liquidity above these highs. Then you wait for price to drop. Don't rush it. What I learned is rushing is what kills us, even when you know. Even when I'm teaching you this, you're going to take time to understand patience. How come this is similar all over? So you take your trade from here. Can you see?
The entry on that is 61%. The stop loss would be at 78.
Yes, but this one I think it looks like it's 78. So stop loss will be above 100, above the previous high.
Yeah.
So basically 100 is the point where price finished taking liquidity, the highest point. Now check now, we are finished with this. Now look at this. If I continue this down, when price is changing direction, can you see how unique this was? This was the simplest trade. I started, if you check my trades, my analysis on live, I analyzed this and price that's gonna stop here, gonna go back exactly at this level. And why is this? There's liquidity below this level. Can you now do this? Look at it vice versa from what we were doing above. Now look at it vice versa. Can you see there's liquidity below the previous low? This one.
Yeah.
The banks, they see that we are buying here. We are buying here. So they first see us. They see we are here. Remember this point. They see we are buying here. And again, we bought here. Then they know when to enter the market. They will buy and sell again. They will buy and sell the same level. They start buying and selling here. Once they see us, they will just put more sell orders to cut our stop losses. Can you see?
Definitely, I'm seeing.
Then check what they do after they cut stop losses. Price does what? Price goes and comes to retest the previous low levels. Boom, we saw this movement. Can you see that? This is called manipulation.
Yes,
this is a manipulation. And what does it do? Price comes back to buy again at the same point.
So question, right?
Mm.
There, where the liquidity is on the buy, then it goes up and sell back, right?
Okay.
Where would you actually know when to? Oh, I actually see it. I know. I see it. I actually see it.
All along, what I've been saying, my old statements, my old teaching now for the past 30, 40 minutes, actually for the past 4 minutes, I'm just introducing you to entries and stop losses. Entry
Yes.
and stop loss. This is now what I'm going to say will change the game. The distance between your entry and your stop loss will determine the risk for that trade. Distance, you see this distance between, if your stop loss is here, your entry is here, you see that the stop loss and the distance between stop loss and entry compared to this one is lower, this one is higher. So here you risk less, here you risk more because the stop loss is close. You see now the stop loss, you enter here, stop loss is above what? It should be above the previous highs, so it will be at 78, above 78 or above previous high here. So the gap between entry and stop loss is huge. You risk less. Here, stop loss is entry, stop loss is here. The distance between entry and stop is very small, so you risk more. Same here, entry here, stop loss above here. This distance will determine whether you use 0.5 or use 0.1 or 0.005 or 0.1, depending on the risk and according to account size. I hope this made sense.
It does.
So now check this. This is what? This is daily. This is daily. I went to daily to show you that you can do this by using this. Let me just save this. So I'm saving this now. You see how I saved? I saved it. Just came here and saved.
Yeah.
Yeah. So it's gonna be recorded there. I like it the way I will use it later now for further thing. Now, once it does that, then you have got 2 points. You've got this point and that point. So this qualifies to be a trend line. Can you see?
Yes, I am.
You see? Imagine how it respects this point and that point. So definitely price of volatility 75 overall in a daily. That's why daily becomes important. Now we know how far it will go. Can you see this?
This is mind blowing.
I'm telling you, bro. and I'm also unlocking it. I'm also unlocking it by having the chance to teach you, because if I wasn't teaching you, I would be lazy to actually have seen it this way. You know, I was looking in another time frame. So now I'm getting you have given me the time to look at it detailed. You know, so whatever we do with this, whatever we do, you will see in a lower time frame. I'm always saying buy, VIX. My signals are just buys because I'm in a buy trend. You can always only realize profit when you buy in this case now from this point onwards. And look at this. This is now, I haven't taught you something, but I'll teach you in the next lesson, maybe then on another day, but because this one will finish just now. This is, before just I go, this is called now when price does that and then breaks the previous, these are called, okay, when price does this, creates structures. This structure is called BMS. Because it's been broken by we've got a new structure which surpasses this one. So this one is a break of market structure. And then goes back to OTE, then another structure. It's broken to a new structure. Then BMS. So this is a BMS. Now you trade in the direction of the BMS. When we look the other side, you'll see that this was the previous structure there. And this previous high price was taken over by this new higher price. And after this happens, after this BMS happens, price goes back to OTE at the previous out to the previous lower level. So this is where you find the interest. This becomes your OT zone. Okay, this becomes your OT zone.
That's with the order block.
No, leave the order block. I'll teach you the order block on another day. But I wanted to simplify. I want to simplify this. I think what I've taught you now, you can all remember each and every one of them because it's so simple. I've put it in simple terms. When you understand this, then I'll go deeper into explaining order blocks, imbalances,
Appreciate it.
inducements, and all that. No, bro, this is priceless. Value for money. This is priceless. So let me, now I need to save this again. Save, you see? Save. I'm going to look at this, and once I break down this, we always win in our signals. Then I'm going back to the hour one. I think this was the hour. Was it this one? This one.